Retirement Systems Common Investment Meeting for June 21st, 2017. We're going to start by convening each board for the public session. Let's start with NYSERS, please. Karen?
Chair,
Here.
Comptroller's Office,
Here.
Public Advocate's Office,
On behalf of Tish James, Larry Schemmel here.
Borough President Manhattan, Borough President Brooklyn,
Present.
Borough President Bronx, Borough President Queens,
Here.
Borough President Staten Island, International Brotherhood of Teamsters,
Here.
Transport Workers Union,
Here.
District Council 37. We have a quorum.
Thank you, Karen. Let's move next to teachers, please. Patricia?
John Adler.
Yes, I'm here.
Thomas Brown.
Here.
David Kazansky.
Present.
Deborah Penny. Charlotte Beyer. Susanna Vickers. We do have a quorum.
Thank you, Patricia. Let's move next to Police Pension Fund. Kevin?
Representing the PBA.
Joe Alejandro, designee for Patrick Lynch, John Puglisi, Mubarak Abdul-Jawar.
DEA.
Michael Palladino.
SBA.
Gary DeRosa, proxy for Ed Mullins, SBA.
LBA.
Lou Turco.
And you have the proxy for the
I have the
CEA?
proxy for the CEA.
Okay. Finance.
Cindy Collins here.
Mayor's Office.
John Adler, representing Mayor Bill de Blasio.
Comptroller. Here. Who do we have representing the Comptroller?
John Dorsa.
Okay. And the Police Commissioner. Okay, we have a quorum.
Just one correction. I also have
Corey Grable, PBA.
Dan Torelli, PBA, proxy for Mubarak Abdul-Jabbar.
Okay, John, we have a quorum.
Thank you, Kevin. Fire Department Pension Fund?
John Adler,
Yes, I'm here, Doug.
Susan Vickers. Here. Cynthia Collins,
Here.
Gerald Fitzgerald,
Eddie Brown has a proxy for Gerard Fitzgerald.
Leroy McGinnis,
Eddie Brown for Leroy McGinnis.
Eddie Brown,
Here.
John Kelly,
Thomas Fallon has John Kelly's proxy. He's on his way.
Jack Kelty,
Here.
John Farina,
Here.
Paul Farrow,
John Farina has Paul Farrow's proxy.
Tom Phelan.
Here.
We have a quorum.
Thank you, Doug. And Burrs, Sandy Rich, you want to,
Morning, Mr. Adler.
thank you.
Mr. Orlando.
I'm here. Hi, Mr. Adler.
Mr.
Hi, Mr. Orlando.
Mr. Matterich is not present. Mr. Nesbitt, not present. Mr. Carmignani.
Present.
Mr. Kraft, not present. Mr. Schuldiner, not present. We do not have a quorum, Mr. Adler, but we will adjudicate these resolutions tonight at our regular Board of Trustees meeting.
Okay, thank you, Mr. Rich. Okay, let me just make a couple of introductory remarks. We're in public session now. When we conclude public session, we will ask all members of the public to depart the room, and then we will go into executive session, assuming the board's desire to go into executive session. And so with that, I will turn the meeting over to Mr. Evans to take us away.
Okay, thank you very much, John.
John, I want to note that Leroy McGinnis is now present.
Okay, thank you. Are there any other trustees who have arrived since roll call? Okay, and let me just make one more announcement. Remember, folks, that when you speak, identify yourselves before your comments to assist our stenographer. Okay, thanks very much.
Scott Evans, Chief Investment Officer. Okay, we are going to give you the quarterly report for the first quarter of the first calendar quarter of the year ending March 2017. It's the third fiscal calendar of the fiscal year. We're going to start off with a macro overview. Mike Haddad, Deputy CIO, is going to take us through that. Then I'll take us through the performance of the funds and take your questions. Mike?
Thanks, Scott. Good morning, everyone.
Good morning, Mike.
So as Scott said, I'm going to talk about market returns in the first quarter, and I'm going to divide it up in 3 different sections. I'm going to first talk about the returns in the markets, and then I'm going to explore a few key themes in Q1 that explain these the returns, and then I have a couple slides at the end about current issues facing markets. So let's jump right in with the returns in the first quarter. Third column shows the returns for the public asset markets, and despite all the noise and distractions out of our nation's capital, it was a phenomenal quarter for market returns. So I would draw your attention to a couple different points on here. And first, the international equities and emerging equities in the first quarter had very strong returns and very strong in contrast to the fourth quarter. Aiding those returns was the weaker dollar in the first quarter, which we'll touch on a little bit later. The second thing that stands out to me is the positive returns in all fixed income asset classes in the first quarter. Again, in sharp contrast to what we saw in the fourth quarter. So in the first quarter, yields were lower and spreads were tighter, which helps explain all those returns. And then one just little side note on high yield, the last row. So the asset class was up 2.3%, but there was a wide divergence between the triple Cs, were up almost 5.5%, the riskiest part of high yield, where the less risky part of high yield was only up a little over 2%. So even dispersion within fixed income markets. So there's 4 different themes I want to talk about in Q1 that were a big part of the reason for the returns. So before talking about this slide, I want to set this up a little bit. So if you recall, post-election, we had the markets had this view that the Trump and Republican agenda was going to be positive for growth and positive for earnings under 3 different ways: the tax reform, the relaxation of business regulations, and the infrastructure program. So if you recall, in Q4, we had an environment where yields were rising and equities were rising. And whether you believe or not believe, you could kind of get your arms conceptually around what that meant. And then as we rolled the calendar into first quarter, there started to be a divergence between what in fixed income we called hard data versus soft data. And what I mean by that, hard data is the actual component data for GDP. So think about consumption data, employment, housing, inventories, net trade, versus the soft data, which is more survey data. So consumer confidence, sentiment data. And as the quarter unfolded, it became clear that the hard data was not up to market expectations. So the first line I'm showing up here is what's called the Atlanta Fed GDP Now forecast. And what this is a dynamic forecast within the quarter of current quarter GDP. So it starts off with markets expectations, and that's the beginning of the blue section, which is the first quarter. So when we started this quarter, we thought first quarter GDP would be somewhere between 2–2.5%. And as the quarter unwound or unfolded, it became increasingly clear that the GDP data was going to be a lot weaker than expected. And you can see the plunge there starting in March when the markets came to grasp that Q1 is going to be yet another weak quarter.
Mike, just a quick question. That's annualized, right? In other words, the expectations for annual GDP?
Yes.
Thank you.
And markets reacted to this. So the second line I put up here is the yield on the U.S. 10-year note. And you can see how as that decline in the GDP forecast happened, the 10-year note started doing the same thing. The scale doesn't show the magnitude of it, but roughly it went from 260 down to, I think that's 220 at the end of the quarter. So a relatively big move in yields and consistent with what you would think with a weaker GDP quarter. And as I alluded to in the first slide, yields were down in the first quarter, and this was a big proponent of it. The second theme I want to talk about, again, is about yields. And it wasn't just the U.S. It was developed market yields were lower. So as a result of a couple things, inflation declining in the first quarter, as well as a couple monetary policy meetings that I want to mention. The first one up on the slide is the Fed meeting in mid-March, and how markets interpreted it was called a dovish rate hike. And what I mean by that, there's 2 different components of that. One is the actual actions and words that they did were more dovish, and dovish refers to, there's a spectrum of dovish versus hawkishness when you talk about the monetary policy. Dovish means less inclined to raise rates. So the 2 things they did is they added the word symmetric in front front of inflation target, and that signaled to markets that they would be tolerant of the inflation rate going a little bit above the target, and that the inflation target was not a cap, it was a symmetric target. The second thing they did is they did not change their expectations for future rate hikes, which markets were kind of anticipating. So the second part of why that's dovish was the market reaction to that. So the FOMC statement comes out at 2 o'clock. By 4 o'clock, markets had moved dramatically. The 10-year note was down 10 basis points, the stock market was up 1%, the dollar was down 1%, and credit had tightened. So the combination of those components all loosened financial conditions quite aggressively, and that's kind of the other component of dovish rate hike. The other policy meeting of note was the European Central Bank, and while they removed some of their very dovish language about potentially having to lower rates further into negative territory, they removed that language, but at the same time, the quote that I pulled out of their statement is on the slide. And this was a signal to markets that although we're removing some of our dovishness, there's no rate hikes coming anytime soon. So the combination of these two policy meetings helped yields go lower, as well as I just wanted to highlight some inflation data that happened during the first quarter as well. So these two lines are U.S. inflation, with the darker line being headline inflation and the lighter blue being core inflation, and core excludes food and energy. So you can see in the shaded quarter that they did peak in that quarter, but came down quite rapidly for a variety of reasons that we can talk about if there's questions. The second two lines are European inflation, and you can kind of see the same patterns. The light green is headline, and the darker color is core. And again, they peaked early in the quarter, and they've since receded. And if we followed that out to today, they're even lower now. The third theme I want to talk about in the first quarter was stronger than expected S&P earnings. And this has quietly been a strong support of the equity market. The green line shows the year-over-year quarterly earnings growth. The scale is on the right-hand side. So if you start this chart to the left, earnings had been negative for most of 15 and part of 16, and a lot of this was due to the energy component. And then as that has worked its way out of the year-over-year growth, you can see the dramatic increase in earnings that's taken place. And this was a strong contributor to the stock market doing well, and you can kind of see how the two lines follow one another. The fourth theme I want to talk about is continued global central bank balance sheet expansion. Said differently, quantitative easing. Blue line is the Fed, and you can see that they've been steady throughout the quarter as well as going back a year. The orange line is the Bank of Japan. The white line is the European Central Bank. So while the Fed has stopped their quantitative easing, in global markets it's still continuing. In the first quarter, that pace was roughly $200 billion a month. And I'll just add that the ECB buys government bonds and corporate bonds, while the BOJ buys Japanese government bonds, Japanese equities, and Japanese REITs. So that all contributes to global markets doing better. It's just the hidden hand behind markets that's providing support to a variety of markets. And I want to step back and show this slide going back to 2008 and the onset of the crisis, because to me this has been the dominant theme in the market since the crisis. And the size of the expansion of the balance sheet, the quantity of quantitative easing has been absolutely tremendous. These three central banks account for over $10 trillion of quantitative easing since the crisis. Bridgewater put out a piece recently that really encaptures it. The period from 2008 to 2016, that 8-year period is one of the best 8-year periods of returns in a 60-40 portfolio. It's only been surpassed a couple times since 1925, and the other component of that has been a declining volatility across asset markets. It's just been a powerful force, and why it matters is because what happens when this balance sheet expansion stops or even reverses. I'm going to get into that into current issues. It's also, as I was rehearsing this, I got a couple questions as to why can't this continue, and a couple responses to that. For those who can remember, if you go back to the 70s, we had extraordinarily loose fiscal policy when the economy was running at or near its potential rate. It resulted in very, very high inflation, and the consequence of that was Volcker having to take the funds rate to extraordinarily high and a very, very, very painful recession. The second one I would point to is the housing crisis that started in 06, 07 before the crisis, and that was a result of too easy of credit and the wrong price of credit. So too much money flowed into the housing market, it was a misallocation of resources, and it triggered the global financial crisis. So again, an example of a misallocation of capital from the cost of credit. Before I go into current, let me pause for a second for any questions or comments on Q1.
Excuse me, Mike.
Who are you?
Ray Santander.
Mike.
Nicers.
You're not Mike. Use the mic.
Showing my age here, but as I recall, the late 70s were also characterized by, there were oil shocks there, 1973, and then later on. So wouldn't that have contributed to the very high inflation rate?
Absolutely. You know, I think there are multiple contributors. That was one. The price controls that Nixon put in place was a part of it. The very compliant head of the central bank, Arthur Burns, was a part of it. So I think a combination of factors stewed into a higher inflation. And it was the fiscal policy from the Vietnam War at a time when the economy was already hot that got us there. So I've listed, this slide's not that different from a quarter ago. So what I want to talk, my two slides are on the second two bullet points on the domestic policy. But before I go to there, I'm just going to couple words on international. You know, a quarter ago, we were all concerned about Europe. They had these elections, there's Brexit, so on and so forth. They've all calmed. The elections went the other way. The way towards pro-EU parties in Europe happened in the Netherlands, it happened in France, Spain's quietly going that way. So the European risk has dissipated. The second big risk that's dissipated is China. I think everyone would agree that they can't continue their policies, that there's some consequence in the credit bubble they're creating, but the timing of that remains very, very, very uncertain. So let me talk about the divergence between the S&P 500 and 10-year yields. So again, let's go back, looking on this graph around election time. Yields going up, the green line, the stock market going up, again, on the anticipation of these very pro-growth, strong earnings by the Trump and Republican parties. If we follow this chart all the way to the end, you can see that the 10-year notes start declining sometime around March. We touched on the rationale for that. But you follow that chart to its end, to the end of May, and you see the 10-year note somewhere down around 220, and the stock market at a new all-time high. And it just doesn't quite make sense that the markets are sending two different signals. Lower yields is typically a signal of something slowing in the economy or lower inflation, and one would think that would hurt the equity market. And you can see the gap in the line, in the two lines, and then there's a divergence growing, and it's certainly something that needs to be resolved by markets. The second thing I wanted to talk about, so the Fed had a big policy meeting last Wednesday, and they do a variety of things in their meetings besides raising or lowering rates. They also release in the Statement of Economic Projections their best guess as to where they think the Fed funds rate's going to be out 2.5 years. So I've shown that in the green bars, and this is the median for the 17 voters for monetary policy. The blue line is what the blue bars is what the markets are expecting. And that's based on a set of futures prices in the front end of the curve, and it's market expectations of the Fed. And you can see the divergence in what the market's expecting versus what's the Fed's expecting. And actually, if you quantify that, in the the end of 17, it's about an 18 basis point difference, so almost one full rate hike. But then you go into 2018, it's 70 basis points, so that's a difference of 3 different rate hikes. And out to 2019, it's a difference of 125 25 basis points, so a total of 5 rate hikes. So the Fed is on a different, signaling something very different, and the markets are reacting very differently. So if the Fed is right, we have higher interest rates in front of us, and if the markets are right, then one would argue that something else in the markets have to change, and that's probably would be the equity market, would be my best guess. So back to quantitative easing and the Fed's balance sheet. The other thing that they told us a week ago was that they are going to start reducing their balance sheet. They gave detailed plans on how they're going to start, the quantity they're going to start, and how they're going to increase it. What they didn't tell us was the start date, and they didn't tell us how much they want to decrease the balance sheet by. In the press conference afterwards, Yellen muttered the words "relatively soon." So one has to interpret what that means in her language. Was it purposeful? Did she slip? Don't know. So markets are now expecting that at the next FOMC meeting in September that they'll make the official announcement, and the start will be either in October or December. So internally, we tried to model that out and what that would look like. So we kind of have it starting, I think if I recall, that's October. And you can see the decline. So it's in the first quarter, it'll be a decline of $10 billion, and it grows to per month, and it grows to $50 billion a month out 5 quarters from when the start date is. Why does that matter? While the Fed was conducting quantitative easing, they were buying a vast majority of what the Treasury was issuing. So there was no net new supply in government bonds. So, and they've been steady since, you can see the flat part of that line, since 2015, and they've been holding their balance sheet constant. And that means the bonds that mature, they've been reinvesting back into their portfolio. Now, the bonds that are maturing, they're going to stop buying some proportion of those. And that's going to result in an increase in supply, and the basic laws of supply and demand that would argue for lower bond prices, which is higher yields. And if you go back to the chart that I had on global QE, this is the first central bank who's reversing QE, and it's, I think, something that we all need to bear in mind over the next several years as the other central banks hopefully do the same. Hopefully, meaning that the economies are strong enough, but it's going to have an impact on asset markets, and it's something that I think all of us in this room are going to have to think about going forward.
John Adler. Yellen's term is up beginning of next year, I think. So what effect would a new Fed chair who, presumably appointed by the current president might do something different from this? What you're thinking about that?
I think it's a key uncertainty for Fed policy going forward.
A known unknown, as it were.
Yeah, known unknown. As much as it's an institution and it's guided by its dual mandate, the person who runs it has a lot of influence over what takes place. And from all the market intelligence, they haven't even started the process of interviewing candidates. You read an article here and there. Yeah, shocking, right? It's a difficult one to answer, because put yourself in the president's shoes. You want the economy to be strong, so you want evidence of that. And if that's the case, then monetary policy is supposed to get tighter. You're supposed to reduce your balance sheet. You're supposed to raise rates. But those things are going to work against the economy in the future years. So who he chooses is going to be important. And my reference to the early 70s is Nixon's Fed chair was Arthur Burns, who was very compliant to what Nixon wanted, and we ended up with this terrible inflation problem for a variety of reasons. So I would answer it with, if he appoints someone who's going to bend to his desires, we're going to end up with higher inflation and higher long-term interest rates. If he appoints a hard money person who's going to take the institution at heart and its mandate, this is going to continue, and we're going to keep inflation expectations around where they are, and long rates would be more steady, would be my answer. Pat?
Patricia Stryker, NICERS. The market, I just want to return to the market for a moment and where it is. Alan Greenspan once called it irrational exuberance. Are we there now?
I'm going to say no, and that's because of the change in earnings. So, there's a lot of ways to value the stock market, price times price earnings ratio, price to book ratio, price to sales ratio, discounted earnings, dividend yield. What quietly has happened is earnings have gotten a lot better. So the PE ratios have been relatively stable despite the rising equity market because of the rising earnings. So we're a little bit expensive based upon earnings. You could argue the stock market is cheap relative to the interest rate markets, and I think what I've tried to really lay out is the interest rate markets have been heavily influenced by trillions of dollars of quantitative easing. And if you want to measure something off a benchmark, it's cheap to that benchmark, but that benchmark is historically, going back hundreds of years, expensive, then there's a problem with it. So if the interest rate market changes, yes to irrational exuberance. But the earnings have been shockingly, surprisingly strong. Thanks.
Thank you, Mike.
Okay, thanks very much, Mike. Every time I sit and listen to one of Mike's tutorials during this SIM presentation, I'm thankful that we have him here in New York City. He's a tremendous asset. You guys get to listen to him once a quarter. Our staff gets to work with him every week, and he runs our monthly portfolio meeting where we bring in speakers. We talk about the macro environment, and the level of dialogue at BAM and our staff has risen markedly since Mike got here. So we're very thankful to have him. So he outlined a dicey situation fraught with risk, where markets are at ebullient levels. I think Mike and I might disagree a little bit on his answer to your last question, and we debate about it all the time. I'm more worried about the equity markets. But we're both a little concerned about the environment, and I think most observers are. But you wouldn't know it from how the markets are behaving. This is our portfolio ranked by risk, portfolio standard deviation. Burrs has got the riskiest portfolio by design, although they're fairly tight. First quarter results were terrific. Fiscal year to date, we're in the 9 to 11 range, well above 7% assumed rate of return, and we haven't even marked the last quarter yet. We're also about 100 basis points ahead of where we would be if we were just investing passively in a 65-35 portfolio. That's the bottom line. They're always something for us to look at because we always have the option of just investing passively on a 65-35 basis. The most interesting number here to me is the portfolio standard deviation, which is in the 3s. And that's really remarkable. You remember when we did our strategic asset allocation that we were in 10% like level. So how the heck could we be at 3? It's because the markets, through all the turmoil in Washington, all the uncertainty about central bank policy, all the uncertainty about Asia and North Korea and everything, has gotten remarkably complacent. And you can see this by looking at this portfolio standard deviation number over time. And if we dial all the way back to April of 2016, you can see we were in the 8 to 10% range, which is about what we would expect for the portfolio. This is looking in the rearview mirror, 1 year trailing actual standard deviation. And then it began to descend, and it's just at remarkably low levels now. I don't know historically how this rates out. But the bottom line here is this is not normal. This is rates are extremely low, valuations are extremely high, and volatility's low. This is as good as it gets. And so we should not be complacent. We should be sure to rebalance frequently to keep our portfolio taut because we're going to get hit by a wave sooner or later. We can't predict when it'll come. We're a pension fund. We don't turn for sure when the wave comes. We're designed to make it through, but it's going to be more volatile, and the returns are going to be more choppy than what we're experiencing now. We have to be ready for that. We can't think that this is normal. All right, let's have a look at the asset allocation and where we were at the end of March. You remember we were in the beginning stages of adjusting to the new long-term strategic asset allocation. For the first time, we're just going to look at the new allocation. And you can see we're a little off the new allocation on these are the growth assets. Everything we're trying to get a risk premium from U.S. equity to international equity, hedge funds, private equity, private real estate, high yield, and opportunistic fixed income. This is the risky stuff. We're a little overweight in U.S. equity at the end of March. We've rebalanced most of that away. And the international is still a little bit overweight, but that BRRRR in green, large overweight, has been reduced. The bands are the bands that we're allowed to travel in without talking to you guys about it. The one that's not going to move that much is the high yield over the second panel from the right. And the reason for that is that we still have to do our high yield procurement, and so that takes a while. We can't get the money to work. I'm not sure we'd be in a big rush to get the money to work anyway. Spreads, as Mike said in his commentary, have really narrowed, so you're not getting paid a lot to go thundering into high yield. So what we want to do is to create some temporary placeholders. We usually don't have placeholders for public assets, where we're going to keep assets in other asset classes. We made use of the MSCI test that we did to run some analytics on the portfolio, and we found some good proxies for high yield in the portfolio. And we're going to come back to you over the next month or so to show you what we're going to do. But we'll have temporary placeholders for high yield until we're able to get the procurement done, get the money invested. And we're pretty comfortable. Miles Draycott and his team did a terrific job of analysis, which we'll show you the working papers from. So that's the growth. It's in pretty good shape, other than the high yield having sort of a temporary underweight. Inflation protection, we're in pretty good shape. Those numbers have even gotten tighter relative to the benchmark. Bank loans and teachers is still a little overweight. The good news, one of the things you'll learn is that bank loans are a pretty good place to defease your high yield exposure, so we're not worried about the bank loan overweight in teachers. Everything else is pretty much on plan. The interesting thing, of course, is the deflation protection, the nominal bonds. We got three different types. There are treasuries, mortgages, and credit. Mortgages and credit, which were way overweight to our current target, have been all brought down, and we've brought the credit down even more since the end of March, which you're looking at here. Treasuries we brought up a little bit, but the Treasury status here is misleading, and that's because Treasury securities go everything from Treasury bills with a 90-day duration or term all the way to 30-year, and the interest rate sensitivity of those Treasuries is wildly different. So hats off to Antonio Rodriguez in the mayor's office, who suggested a new slide for us to use that would show the different interest rate sensitivity. We immediately agreed with him that it would be a good thing to add. And we're going to put this next slide in until we bring the portfolio up to target duration, duration being interest rate sensitivity. So here it is. The duration in years is on the vertical axis, and then the different systems are on the horizontal axis. The gray is the duration of the current portfolio. That's the interest rate sensitivity of the current portfolio, and the blue is the target. So you can see, even though police and fire in the last panel looked like they were the closest to target, the gap is actually pretty large in police and fire and teachers. And of course, those are the three systems that have opted for long duration. We're in the process of closing that gap. It's killing us to close that gap because rates are so low. But discipline is discipline, and we're slowly, reluctantly closing the gap as per plan.
But in the first quarter, if I'm not mistaken, long-term treasuries did really well, right? I'm sorry, John Adler.
Yeah.
I think.
During the fiscal year-to-date numbers that you're just looking at, they did very poorly.
I was looking. I'm going back to Mike's slide. So.
Yeah, his was on the.
Yeah, but that's consistent, John. Prices are up, yields
Yeah.
are down, which
Yeah.
what we've had to buy has been low
Yeah.
yield.
Yeah. Yeah, this is the fiscal year-to-date through this period.
Right.
Rates were actually going up, which it was a good thing. You'll see as I go through the slides, it was a good thing that we were underweight. We
Fiscal
benefited.
year-to-date down 9.6,
Yeah.
but first
R-
quarter up
rates-
2.6.
Yeah, rates were going up during most of the fiscal year.
Yeah.
And then at the end, they started to go down. And that's working against us here because we want them to go up.
Yeah.
And because we're short, and as they go up, then
Right, I understand it's a hedge.
yeah. But this is a hedge. We're not doing it for offensive purposes, and
Understood.
so.
Okay.
In any event, we'd rather be buying, the bonds at 260 rather than at what was it, 215 now? Yeah. Anyhow. There's a look at it, and this is really the key stat to look at for the portfolio for treasuries, and really the most interesting thing is going on in allocation. I'll go through the rest of this quickly because it was a good and fairly dull quarter, and I'm going to show you the fiscal year-to-date results because a quarter is just too short a time period. So this is the first 3 quarters of fiscal 2017. The portfolio and the benchmark are up in the 8 to 9%, and you can see BRRRR is over 10% during the period. But when you compare the portfolio to the benchmark, what's the excess return? It's positive and modest, so decent. So now we're going to break down that excess return, and we'll change the scaling a little bit. So you see the same right panel on the left at a different scale, plus or minus 600 versus plus or minus 1200. So the excess return can be broken down into asset allocation and manager value added. And you can see that there's some asset allocation in here. It's pretty modest. And then a decent amount of value added, particularly in BRRRRs, which runs a more concentrated portfolio. So they tend to be the most volatile, either up or down in manager value added. If you look at the total portfolio versus the 3-year trailing, the value added, now we're just going to look at manager value added, is good, a little better than we've been. Managers are performing better than they have been historically, which is good because we were frustrated with that. Equities, things are pretty flat, although our equity managers actually struggled to keep up with their benchmarks. We're a little overweight small cap, and small cap was by far the strongest part of the sector. Net, it kind of evened out, and we had a flat quarter versus the benchmark in equities. International, we did quite well in international. Now, there's been some seesawing, but over the period, value well, first of all, let me tackle emerging markets. Emerging markets were by far the strongest part of the international market, and our managers did super, outperforming, all but one outperforming the benchmark. And so nothing but happiness in emerging markets. We had value actually dramatic. Off the ball, and it just goes to prove that by being a patient, long-term investor, knowing our managers extremely well, visiting them, the same people at BAM, watching the same people at this manager year after year after year. We had the conviction to add to our position when they were down, and they blew the cover off so far in this fiscal year, and were a big part of this outperformance. So it's tough to be a long-term investor sometimes, but there is a good payoff. Fixed income, solid performance by our managers, modest, more modest than what you see here. A lot of this distance, and it's still pretty modest, was our low duration relative to the benchmark target when the yields were going up and the yield curve was steepening. High yield, not much to talk about during the quarter and the fiscal year to date. Bank loans, we struggle to keep pace in bank loans. We think we have good managers here, solid managers. This has not been a terribly good period of time for them as they've struggled to keep pace with the benchmark. Hedge funds, we have two continuing hedge fund portfolios. Police and fire, both a little shy of 5% of their portfolios. Very solid fiscal year-to-date results, a broad cross-section of outperformance of the hedge fund indices. Our macro trading manager has struggled, particularly with global events, and we're not concerned about that. We have a tremendous amount of conviction as this manager. As you know, you all saw him recently when we beamed him in from his location. Unfortunately for NYSERS, as we've been liquidating the NYSERS portfolio, the piece of the portfolio that was left was pretty much all this guy during the period. So that's why NYSERS did so much poorer. But it's the dollars involved are only 43%, or 43 basis points of the NYSERS portfolio. So it really is a tag end that looks large here. All right, I'm going to turn the gauge now to private markets. Remember, we measure private markets differently. You've been looking at time-weighted returns. We're going to go to dollar-weighted returns. And rather than just looking at fiscal year to date, you're going to look at cumulative returns relative to a public market equivalent benchmark since the beginning of our programs, in some cases going back to the 1990s. And I won't go more into that measurement, which you're now familiar with. The target in private equity is 300 basis points. We're positive in 3 of the 5 systems, but still well short of that target, and that hasn't budged much over the past quarter. Opportunistic fixed income in positive territory, but yet not at the 300 basis point target. Core real estate, suffering from unfortunate timing of when we put these plans into place. So BRRRRs that waited till 2010 to put their core real estate program together caught the upside in the new underwriting processes, whereas NYSERS, police and fire, jumped in earlier, right before the crisis, and felt some of the pain of that. And teachers had a more gradual increase in real estate and wasn't hurt quite as badly. But the recent results have been positive, marginally so, and the numbers are getting better over time. Non-core, similar types of effects. There were some differences in the teacher's portfolio in its timing, and it also had a manager that did quite well just after 9/11 that you're all familiar with that helped them. It also helped NYSERS, but they had this effect of NYSERS aggressively increasing the allocation and teachers gradually increasing the allocation. The thing I like to focus on is the benefits of the new underwriting standards that we have at BAM, which started in 2010 with my predecessor, Larry Schloss, and we've continued. You can see it in the BRRRRs numbers, and everyone is investing in the same mandates, and so for the most part, and so you can see the benefits of that shining through since 2010. Infrastructure, everybody started recently, 2013. Petya Nikolova consistently comes in with very boring and consistently positive results, and we love those, and would love to see results like this all the time. There's not much to say. We've been in good managers. They've done well and exceeded our expectations. Always good to end on an up note. I'd be happy to take any questions before we go to the executive session.
Any question? Oh, Dave Kazansky. Yeah.
Dave Kazansky, teachers. I heard that over the last couple of days that MSCI is going to add China to some of their benchmarks, or one of their benchmarks. Does that affect any benchmark that we use with MSCI? And since I know our board doesn't invest in China, will we have to search for another benchmark to use, or are we not affected by that at all?
So in terms of the portfolios, the portfolio strategy would be unaffected, because if you carve out China, we'll continue to carve out China. The benchmark will be less reflective of. I'm sorry. The benchmark will be less reflective of the. The benchmark will be less reflective of our portfolio, but I think it's useful not to change the benchmark. And this is something we can talk about more in detail, because when you don't invest in any part of the benchmark, you're making an active decision, and that active decision ought to be measured against the investable universe that you could invest in, and so I would just keep the benchmark, but what we'll try to do is to analyze how much of the difference from the benchmark was due to the tilt that you put on in terms of your instructions to BAM, and how much was due to BAM's execution of the instructions that you've made. So that's the way I would recommend that we follow it, rather than starting to build all these custom benchmarks, because you lose track of whether the changes that you've put on to the investable universe are having effect or not.
Scott, you might want to be more live there. I think some members of the audience are asleep.
Other questions for Scott? Okay, Ray.
Yes, Ray Santander, NICERS. Scott, in talking about the private equity returns or excess returns, are those returns of funds that have already been, been realized, or is it the whole portfolio kind of moving?
It would be the returns and the internal rate of return for the whole portfolio since the beginning of our investment in the asset class. So it's actually what we've received. What we'd use as an end valuation in the case of the funds that are still invested would be the latest valuation of the portfolios, what their carrying value is.
So that gets to my next question. In terms of the valuation, how much of those valuations are self-reported versus you and your staff, a third party have the chance to look under the hood, so to speak?
Yeah. So what you have is interim valuations that are self-reported by the managers for the most part, and then annual audits of those valuations to reflect the process that's being used, the independence of the auditor in coming up with the valuations. So there's a check. We also have an administrator that checks the valuation process as well. So it's not possible for them to be marked to anything, and we follow the same sets of standards and procedures in our other private asset classes. Okay. I don't know if Alex, if you'd like to amend or append. Yeah.
Okay. Thank you.
Okay, other questions for Scott? Okay.
Okay, thank you. That concludes our, it does not conclude. I stand corrected.
So very quickly, I just wanted to let everybody know, I'm Susanna Vickers from the Controller's Office, and I just wanted to share with trustees our plan for summer trustee education program in July and August on the third Wednesday of each month when everybody saved the date on their calendar for a potential sim. Since we're not having sims, we are making staff available to sort of delve deep into topics of interest with you. And down in the caucus, we'll have a suggested list of topics that we'd like everybody to rate or suggest their own. So we can talk more about it in the caucus, but just to let everybody know what that item is. Any questions? Thanks.
Okay, thank you. So I do think that concludes our public session business. So we'll take motions to move into executive session. Let's start with NYSERS. Is there such a motion?
So moved.
Is there a second?
Second.
Okay, motion made and seconded. Any discussion? All in favor of the motion to exit public session and enter executive session, please say aye. Aye. All opposed, please say nay. Any abstentions? Motion carries. Thank you. Teachers, is there a motion?
So moved.
Just say it out, please. Mr. Brown. Just to enter executive session.
A motion to enter executive session.
Thank you. Is there a second?
Second.
Great. Any discussion? All in favor of the motion to enter executive session at teachers, please say aye.
Aye.
All opposed, please say nay. Any abstentions? Okay, motion carries. Police?
Motion to go into executive session.
Thank you. Is there a second?
Second.
Thank you. Motion made and seconded. Any discussion? All in favor of the motion to enter executive session, please say aye.
Aye.
All opposed, please say nay. Any abstentions? Did you nay? No. Okay, motion carries. And fire, is there a motion to enter executive session?
Motion to enter executive session.
Great. Is there a second?
There's a second. Doug White making a second.
Thank you. Any discussion? All in favor of the motion to enter executive session, please say aye.
Aye.
All opposed, please say nay. Any abstentions? Great, motion carries. Great, I think that ends public session.
Presentation from a manager and a recommendation from the Comptroller's Office and the asset class of infrastructure. Action was taken, details to be made public at the appropriate time. The trustees also heard a presentation from a manager and a recommendation from the Comptroller's Office in the asset class of real estate. Action was taken, details to be made public at the appropriate time. The trustees tabled a discussion on contract terms, details to be made public at the appropriate time. The trustees also approved the responsible contractor policy and noted their electronic vote renewing the common investment meeting for a period of 6 months.
So at this time, we have no other business. We'd like to make a motion to adjourn.
Second.
Executive session. An infrastructure deal was presented and discussed. Consensus was reached. Will be announced at the appropriate time. A real estate deal was presented and discussed. Consensus was reached, which will be announced at the appropriate time. Trustee education topics were discussed. A change to an ongoing project was discussed. And an update on a manager was presented and discussed.
So I believe that's the end of your
It is.
Seeing, I don't believe we have any other business. We have a motion to adjourn. So moved.
Second.
All in favor? Aye. Have a nice day.
Session, Karen, will you please?
And we're back.
Yes, the board took one action on infrastructure investment, the details of which will be disclosed upon contracting. The board took action on one real estate investment, the details of which will be reported upon contracting. And the board agreed to final terms of the strategic partnership, the details of which will be disclosed.
Thank you very much. I think a motion to adjourn is now in order.
So moved, Mr. Adler.
Thank you, Mr. Bernard. Is there a second?
Second.
Thank you, Mr. Dorsa. Any discussion? All in favor of the motion to adjourn, please say aye.
Aye.
All opposed, please say yay. Any abstentions? Motion carries. We are now adjourned.
Session, the board discussed various investment matters reviewed personnel decisions, and also made decisions about which candidates to hire. We now need a motion to adjourn.
Motion to adjourn? Second.
Any objections? Hearing none, motion carries. Thank you, we are adjourned.
Good job.
Thank you.